Well, Steve, thank you so much for joining. Where are you coming in from today?
Thanks for having me. I'm coming in from the coast of California, halfway between Santa Cruz and Half Moon Bay.
Nice. Well, you've had, I think, such a illustrious, comprehensive career in and around venture and kind of the startup ecosystem, both as an entrepreneur yourself, and then also, I think, a thought leader around kind of the lean startup movement. Can you just give, for those in the real estate industry that aren't as familiar with your background, can you give a cliff notes of kind of your bio for them?
Yeah, I think I've had a couple of careers. I spent 4 years in the Air Force here in Vietnam, a couple of years in Southeast Asia. And then I came to Silicon Valley and did 8 startups in 21 years, kind of a string of attention deficit disorder companies, but had or was certainly part of 4 IPOs out of 8. But the thing that actually made my career and what I teach about now are about the 2 failures, which left craters so deep they have their own iridium layer. But those failures actually helped me think about, when I retired out of my last startup, the nature of innovation and entrepreneurship, and realized that the common wisdom, which we could describe later, was wrong, and helped create a method of building new ventures and new innovations called the Lean Startup Method. And so now I teach at Stanford as an adjunct professor and as an innovation fellow at Columbia University on the nature of innovation and entrepreneurship.
And can you give people just like a quick synopsis of the lean startup method? And I have to say, with some credit due where it ought to be placed, when we started Fifth Wall back in 2016, we actually tried to kind of pioneer a new business model and a new approach to venture capital. And I would say a lot of your thoughts and your writings were inspirational to us as we launched that. So I have to say thank you.
Yeah. So do I get the check for Carrie, Brendan, or just a thank you?
Yeah, it must be lost in the mail somewhere.
So the core of the lean startup could be described in one sentence, which is there are no facts inside your building, so get the hell outside. The second, again, short but relevant quip is that no business plan survives first contact with customers. And now let me go back and talk about lean itself. But you ought to think about what those 2 sentences actually meant, because they're absolutely true. In the 20th century, investors in early stage ventures simply said, without, I don't ever think muttering these words, but what meant them was that startups were nothing more than smaller versions of large companies. But what they told their investments to do, their startups, was, large companies write business plans. We want you to do that. Large companies give us 5-year forecasts. We want you to predict the future. Large companies, hire management teams of sales, marketing, biz dev, engineering on day one. We want you to do that as well. And by the way, since we funded your vision, and here's the critical point, we want you to spend the next months, or back then it was years, building out the product or solution exactly as you sold it to us in your initial venture pitch. Any deviation from that was not considered innovative, it was considered a failure. And therefore, the entire model was what I would call execution. You were going to execute to the plan, just like a large organization would do for product 5, 6, or 10 that's been around for 10 years. In fact, on day one, a startup or new venture is nothing more than a faith-based enterprise. It's a religious activity, because all you have is a series of untested beliefs. So make a long story short, and my apologies for the soliloquy, when I retired, this light bulb went off, which said, we've been trying to emulate large corporations, and they've been kind of learning on how to build companies for 100 years from tools and technologies out of business schools and consulting firms, et cetera. And so there was kind of a management stack of thinking and tools for corporates, but there was almost no thinking about how startups were different. And I realized we needed our own tools, our own techniques, because here was the other core idea. Large companies execute known business models, but startups search for business models. And this distinction between search and execution had never, ever been articulated before. So I decided that we needed to build them. And it was a pretty heretical, event of taking on everybody who said, well, Steve, all these other people seem to think this is the right way to do it. And so I developed something called the customer development methodology, which was around that first insight that there are no facts inside the building, that all you're operating on there is hypotheses. And it's just a framework of how to get out of your office, frame everything you had in your business plan, which we're calling a fact, actually admit that most of them are just effing guesses, and we give them a fancy name called a hypothesis. And pretty soon, one of my early students and one of the companies I invested in, a very smart guy named Eric Rees, observed that, Steve, in the 21st century, engineers are starting to use something called agile engineering to build products and services iteratively and incrementally, rather than in a serial process, which we used to do called waterfall. That's a perfect match to this customer development model. And soon we paired those two together. And so we had customer development and agile engineering to build products incrementally and iteratively. And once we did that, we could get out of the building and test not only the ideas, but test the product or service by building what we call minimum viable products. That is, small pieces or demos or spreadsheets or price lists or whatever, way before we were actually ever shipping or selling the product. And then finally, there's only 3 pieces to lean. It was that someone named Alexander Osterwalder came up with something called the business model canvas, which was a single piece of paper that allowed new ventures to kind of get reminded of what are the 9 things that are critical that they need to figure out. One is, who are the customers? 2 is, what are you building for them? What distribution channel? How are you going to keep and grow them? What's the revenue model? What activities are important? What are the resources? Who are the partners? And what are the costs? On day one, most of those are just guesses. And so now the lean methodology is map out your hypotheses with this canvas, get out of the building with a customer development methodology, build product or service incrementally and iteratively, continually getting feedback through these MVPs.
I know that a lot of corporates try to emulate your methodology and bring it kind of in-house, but I guess what's your explanation for why corporate venture has struggled to replicate the innovation and the speed of iteration that can be achieved in an independent startup? Why is it so hard to do in big companies?
It took me a while to understand that. In fact, I want to apologize for every corporate who simply thought that they could take startup tools and apply them in large corporations. In fact, in May of, almost 7.5 years ago, 2013, the Harvard Business Review put it on its cover, Why the Lean Startup Changes Everything, which gave permission to corporates to go, oh, all we need to do is plug in these tools and we could be as agile. And I believe that as well. The sad report is what we created is 7.5 years of innovation theater, not innovation. In a startup, 100% of your company is focused on mission, which is searching and finding the business model. And we call that searching for what's called product market fit. That is the thing you're building, just like your search when you started the Fifth Wall, and the customers match. And how do you know that they match? In the simplest terms, when you show up, they grab what you have out of your hands even before it's done. You have product market fit. But if you think about it, in a startup, at least when you're small, the entire company, there is very little overhead, is focused on searching and building out that business model, and we're all passionately focused on search. And by the way, there's 100% commitment in a startup. We still kind of have a different ethos and generally than from large companies. People are working for mission, which is funny ways because they're also motivated not for mission only, but also for equity. That is, they're all shareholders to some extent, and that liquidity event will have a meaningful impact on your life. Now let's fast forward to a 10,000 person company. Most of them, I'd say 99%, they didn't come to work or get hired for search. They get hired for execution, which means there's a business card, which is a hot link to a job spec, which was made by an HR person who realize that this job has been done before. It's a known set of activities, and that's what you're hired for, is your ability to deal with repeatable and scalable activities. And so if you think of that distinction on day one, these are very different structures, very different motivations, very different people. And, um, and so trying to do innovation inside of an execution structure is by definition already hard, because most people don't realize they're very different activities. I mean, they're barely related, and it requires leadership on the top to truly understand that you need to build what these guys named Tushman and O'Reilly coined the ambidextrous organization, one that could execute and innovate at scale without destroying the core business, but realizing that all your innovations are eventually going to move to your core over a period of years. If your VP of sales is, oriented for execution and the comp plan says X or Y, any deviation that might diminish that, like, no, you can't talk to customers about new products, that'll make them stop. I mean, you hear this a million times. Typically, the biggest killer of innovation in large corporations is the head of sales or your general counsel. Can you imagine someone showing up in Marriott on day one and saying, hey, why don't we just rent out apartments of other people? Your general counsel would have said, like, which attorney general would you like to be sued from first? Well, obviously that was Airbnb. And all those other innovations that actually don't make sense, because you have obligations to shareholders, you have obligations to your board, you have obligations to not betting the company. Remember, every startup is a 100% risk bet on the entire company, not a piece of it, the entire company. There's no way you're making those bets in large corporations. So if you would just stack the columns of motivation, percent of people doing innovation, barriers, etc., large corporations are at a disadvantage. The only thing that kept them in a leadership position in the 20th century was access to capital. That is, startups in the 20th century were essentially ankle biters, maybe got up to the ankles of large corporations because they were capital limited. I mean, they might raise $5 or $10 million, or maybe at the end, $30 million. But nowadays, startups have access to at least as much, if not more, capital than large corporations. Boy, that world has turned upside down. So now you're combining the ability of startups to move with speed and urgency versus a corporation trying to protect its core business and trying to innovate. It's not a fair fight anymore.
And I think in the real estate industry, what you're describing is like acutely true, right? Because the real estate industry it's 13% of the US economy. And it's this industry that basically sat out 2 decades worth of innovation, right? The real estate industry effectively missed the entire internet and all of mobile. And in the last 5 years, this kind of epiphany light bulb moment happened where real estate CEOs were like, oh, we have to have a point of view on tech. The tech boogeyman is coming for our business. And part of that was informed by exactly what you described, which is the experience of the hotel industry and first the OTAs, the Pricelines and the Expedias of the world, then the hotel industry and Airbnb. And then it started to come from other vectors, right? Suddenly now the data center, the REIT data center business became bigger than many of the big office and retail REITs. And at the same time, co-working was encroaching on the office industry. And so you had this clear motivation that we want to do tech, but as I've engaged with corporates, I've noticed this interesting dichotomy where no one understands their pain points with respect to technology better than the corporates themselves. They are acutely aware of what they would like to exist and intuitively what should exist. But at the same time, they're incredibly bad at selecting the companies to partner with and to engage with, meaning there's this kind of adverse selection where the companies, the startup companies that are well capitalized, have strong investors, strong teams, real growth, have the potential to scale. They don't want to sign exclusive deals with big real estate corporates. They want to be Switzerland. They want to be neutral and grow and leverage the corporates where they can. Some companies that are sweating cash, right, that are not able to raise financings, they go to corporates and they kind of become corporate darlings. But at the same time, those are not the companies you want to partner with. There's this adverse selection. And I guess when you've advised corporates, how do you advise them to overcome that adverse selection problem that seems to plague corporate venture capital so intensely?
Well, there are a couple things, and one is, let me remind your listeners, and I'm sure this is true in real estate as well. There are more innovators inside of large companies than there are in startups. It's a big idea. Um, they might have different risk profiles because they need medical insurance, or they need, a guaranteed salary. Or if you really think about it, what you have internally almost always is a corporate VC group, a corporate M&A group, innovators and entrepreneurs trying to bang from the bottom, saying, "Hey, we're over here, talk to us." And very smart people who at the bottom of the organization are the first people to tell you which external deals you should do, because they're the guys who have to deal with this crap. But you put somebody in M&A who has no idea what the technology is about to kind of do a partnership with these second tier companies. The point I'm trying to make is that part of the problem in large corporations is not the lack of innovation, though there's a bigger brain drain now than there was 5 or 10 years ago, but in fact a failure of organizational design. That is, companies are still not designed to deal with innovation as an integral part. It's still kind of either a point activity or some silo or something else. And a potential solution is to try to think about, if you want to survive, that you really need to be integrating these things at the C-suite. And you need to get aligned, obviously, with your board and your investors. I mean, if you're dealing with activist investors, maybe this isn't going to work. But if you have some control out of your own fate, I would be thinking about how to organize from the top and integrating these activities. And the activities I mentioned, are corporate VC, M&A, and an internal innovation process that says, "Oh, I understand. We could build, we could buy, we could partner, whatever." But these are not separate activities.
One of the interesting things also that I find fascinating about kind of an artifact of like old school corporate venture capital is this mentality of using corporate M&A and using corporate venture capital with an anti-competitive mindset. And what seems to happen is that almost accelerates the adverse selection, because only the companies that are willing to sign exclusive deals with one big corporate, which tend to be the worst companies in the startup ecosystem, only those companies are chosen by the big corporates. And one of the approaches that we took at Fifth Wall is we said, well, what if we could build a consortium of the largest owner operator developers from the same industry that are in fact competitive with one another, put them all in the same fund. And by virtue of having all that distribution, the very best startups would want to partner with us. So for example, in home building, Fifth Wall has Lennar, D.R. Horton, Pulte, and Toll Brothers. So 4 of the 5 largest home builders are in our LP base. And what that kind of enabled us to do is, at the beginning, all these home builders were looking at the space called, what is today called iBuyers, right? So Open Door, companies like that. They were looking at the category, they were very interested in it, but they were all focused on these subscale companies that were willing to sign exclusive deals with them. And what we were able to do is kind of redirect that intention and say, why don't we focus with the best in class startup, a startup that's never going to sign an exclusive deal with any of you. But by virtue of working with all of you, they can have more distribution and you can get access to the best entrepreneurs that are really going to be able to accelerate your business. But it required a huge mental leap from these corporates to say, I'm going to be in a corporate venture capital fund with my peers in my industry. And the reason I'm going to do that is because in so doing, I'm going to get access to a higher quality startup, a higher quality entrepreneur that actually has the potential to more expeditiously change my business. And we've actually struggled in the early days to overcome that because it was so counter to this, I would say like an anachronistic 1990s style approach to corporate venture. I guess, how have you seen other corporates approach that, right? Because it is a real dynamic, this anti-competitive mindset.
Well, I think what you just described there, 2 new business models. One is yours, which is a new business model, which as it seems is directionally correct, and but also this mindset of large corporates are now realizing that that there's stuff external to them that is so critical and important, that they can make, as you said, adverse decisions to have exclusive. But the new model is to kind of get the best in the breed. I also think what they're going to discover is it's the creation of new business models or new technology that they need to have an early warning sensing system about, that are not only things that they could use, but things that might completely disrupt their, how do you reach customers, or different building techniques, or different ways people will be buying homes, etc. The pandemic has changed everybody's model. At the same time, the collapse of malls and the rest, and the rise of online shopping, and the question of whether people will ever come back to work 5 days a week, I think we're going to see an explosion of new business models that threaten almost every incumbent in that space.
It's interesting hearing you talk, because it sounds like you share a lot of you've kind of written about a lot of the things that to some extent we experienced as we were talking to these corporates and bringing them into our consortium. Like, our consortium is now 65 owner operator developers of real estate who have never before invested in a venture fund from 15 different countries. And we, in that consortium, connect them to these technologies. But in doing so, we kind of learn that there's almost like these three buckets of motivations that go from like the most base to the most altruistic, enlightened, exalted kind of motivations. The first is what we were just describing, this anti-competitive mindset, which is like, I'm going to invest in this technology. I'm going to stop this technology, regardless of whether it's good. I'm partnering with my peers. That was like corporate VC 1990s style. And to be honest, it does persist a little bit today. That's like bucket one. Bucket two, as we've encountered it, is I have these pain points. I want to get rid of them. Get rid of them. It's kind of like my business is inefficient, make it more efficient by tech enabling it. So it's usually kind of enterprise software. So, solutions that are workflow driven, that improve some internal processes, make them more efficient, make them more trackable, render them with data, but it's kind of like streamlining the core business. And the third is kind of what you were referencing, which is existential threats, meaning that technology and mobile and the internet basically unearth this kind of juggernaut of trends and changing consumer behavior patterns that in and of themselves might be hard to understand, but certain features of it have the potential to disrupt my business, like Airbnb and short-term rentals and hotels, meaning no one could have predicted that with the rise of just the internet. It just kind of evolved out of consumer behavior, and it was a new business model, and it competed directly with hotels. And what we've seen is that corporates that lean most aggressively into that last category tend to be the most successful, which is they approach businesses that they're like, this is interesting. It's kind of scary. It has the potential to really threaten my business. I'm not sure how I'm going to work with them. You know what? I'd rather work with them than not, because I'd rather stay close. I'd rather understand. To your point, I'd rather internalize those learnings, internalize those insights, internalize that new business model into my business, and find ways to cooperate with them to accelerate each other's businesses. That has consistently been the most successful approach. But what's unfortunate is that a lot of corporates sit in those first two buckets still, which is stop my competitors from using this technology or make my life easier. And that's corporate VC to them.
So Brendan, what you just said made me think about, this thing of that we say about startups is that if you're not failing a lot, you're not trying hard enough.
Right.
Meaning, failure is an integral part of learning and discovery. That is, when you're testing hypotheses, it's the scientific method, and you have a hypothesis, you design an experiment, you test it out of the building, and most of the time, just like in a lab, it blows up or doesn't work or whatever. And we don't fire the scientist when that happens once. We just, kind of clean up the lab from the explosion. We run another experiment, and that's the constant process of learning and discovery. And which makes kind of the people who do that have a kind of different mindset than those who come to work for just execution. And I want to just remind your listeners of that. But what you just said reminds me of corporate VCs. The motto should be, if you're not scared yet, you're not investing right. I mean, that would be the motto. If you're comfortable doing investing, you're about probably on the path to put your company out of business, because
Right.
because you might as well just put the money in the bank and get 1% interest, because those are the safe bets. Real estate venture capital and the whole notion of innovation is that most of these things fail. That's a big idea. So the
Right.
people who are going to be your customers are the CEOs whose boards are hitting them with a stick, or those smart enough to go, wait a minute, there's actually writing on this wall and it doesn't look good because it's written in blood. Wait a minute, that's our blood. We might want to figure out how to fix this. And again, it's hard remember I talked about this ambidextrous organization and organizational design that actually recognizes that in environments like this, you need to be still executing your core business, but by understanding you need to build out a cloud of innovation processes, not just activities, not just an investment or an M&A, but it needs to be a continual cycle, because all those things that look like they're outliers will eventually, some of them will converge in 2 to 4 to 5 years to be your core. I kind of now come to the conclusion that innovation happens in companies in one of three times. One is when you fire the CEO. That is, there's a leadership change. Almost always the new guy or woman doesn't come in and say, hey, everything was fine, let's keep doing it. That's an opportunity for innovation. The second one is when there's a crisis. The pandemic is certainly a crisis for the real estate industry, on everything from hotels to, I mean, I don't have to tell your industry what it's like, but if you're still doing the same thing when we're out of the crisis, you've missed a huge opportunity, A, or B, the business models will change, which will force you either out of business or to change. But that's number two. But number three is, if you're a very, very smart CEO and management team, you have early warning radar going on that says, bing, 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 something's coming, we don't know what. Let's build an organization before stuff happens to us. And that's rare, but I think it's been rare because we haven't built a playbook for CEOs. Much like I built a playbook for startups with the lean methodology, there really isn't an innovation playbook for large corporations yet. I'm actually in the middle of writing one.
Oh, right. Well,
because I realized I was the cause of a ton of innovation theater. I think I owe it back to.
I'll have to. I know what my next Christmas gift for all of our corporate LPs next year is going to be.
Well,
it's out for next Christmas.
The Christmas gift will be, I'll be able to write it. But it starts with kind of a big idea of, everybody in the management team and board needs to agree on context. And by context, it's simply, are we screwed or is everything okay? I mean, it's simple as, right? If everything's okay, then let's just keep doing what we're doing. If we're screwed or we see something coming and that's not a 2-foot wave, but it's a 200-foot wave, then perhaps we ought to agree that we need to organize. And then, and when I say with your board, because sometimes this requires things that will take a hit to dividends or stock price or whatever in the short term for a long-term change in business model or strategy. The second thing is getting your exec staff aligned. Again, if your head of sales is compensated on X, maybe you want to change some of that so they have overrides on some of these crazy new things. So instead of sitting there like this or figuring out how to screw it, they'll actually be motivated to incent it. And then building a process that cuts across all these traditional silos of, so one is context, second is leadership, third is building innovation pipelines and process. And then, underneath all that is all the support things that need to change. Your financial people need different models for investments in long-term innovation versus ROI calculations for existing construction, right? If you're using the same model, right, then everything new gets, it doesn't meet our financial model. Or HR, if we're just, putting the most experienced people rather than the most creative people into some slots, you've kind of missed the opportunity because it's usually the crazy people who create new things. It's usually, not always, but somebody's been executing the same job for 15 years is sometimes not as amenable to change as some others. So these require changes on the bottom as well. But there is a playbook one could build for innovation in large corporations. But it really starts all the way on the top with what kind of you saw when you were building Fifth Wall, is that the context has changed. The world's changed, and there's opportunities to do different things with different models. And sometimes companies just go out of business because either their board and or their CEO don't get it, and stuff happens to them. People forget that there's a life cycle of corporations. It used to be a public company in the US survived for about 50 years on the New York Stock Exchange in the middle of the 20th century. That's a joke now. The average life cycle of a public company is about 15 years rather than 50, and decreasing, not because CEOs have gotten stupid, but because of everything we've just described, is that the world around us is changing at such a rapid pace. Internet, globalization, new tech, new business models, piles of VC money for startups, not large corps. That makes CEO decision making so much harder. And in fact, what I remind my students, and there were corporates I talked to, is everything you learned in business school other than accounting, if you've been to business school longer than 5 years ago, is obsolete. It's a big idea.
One of the things you said that strikes me is, there is this, when we obviously talk to corporates, they compare investing in, say, Fifth Wall or any corporate venture strategy, they compare it on an ROI basis to projects they know. So literally they're like, well, I know if I replace a roof at this building, I know what the ROI of that is. And now you want to have me put $20 million into Fifth Wall, I can't see the ROI. And I was, I almost want to say, well, that's like one surefire way to ensure that you're on the wrong side of history, right? Like that is a lockstep way to make sure you're part of that, increasing death rate of public companies. Like what worked historically won't work in the future. And the other thing you said that really stuck with me is the idea that you should be a little scared, right, in these partnerships. We would talk to some corporations early on, and they would say, yeah, we started doing corporate VC, we started investing in startups. And typically what happened is it was like the person at the office who used Facebook the most was a venture capitalist the next day. It was like a battlefield promotion, and now you're a venture capitalist. Like, it's kind of fun. It's kind of fun. It's cool. And I was like, look, I do venture capital for a living. Let me tell you, if you're having fun, you're doing it wrong. It's not supposed to be fun. It's actually supposed to be mainly scary and intense and confusing. Like those are the sentiments you should have around doing corporate venture. And I think over time it is changing. That's the positive news. I think more corporates are embracing that change. They are seeing that this juggernaut of technology is coming towards them, and that doing corporate venture, investing in companies you don't fully understand the nature of the partnership or the provable ROI, is a way of staying ahead of the curve of avoiding disruption. But anyway, I'm excited to send your book to all of our corporate LPs. I think it'll be good reading for them.
Well, I think the high order bit, Brendan, is that there really needs to be a different mindset now for CEOs who want to survive for the next 10 and 20 years. I mean, it's quite possible to eke out profits, with existing business models. And, if you're going quarter to quarter and you're a public company and you're, the question right now is your CFO driving the company, or is your innovation model driving the company?
Right.
And again, I don't want to diss P&L. Obviously, the core needs to be profitable to survive. But if that's the only metric you're using, that is, if the only metrics you're using to see the future are financial metrics on current business model, I will suggest that life is not going to be pretty in 5 years, certainly in 10, particularly in the real estate business, which is undergoing finally the massive change that every other business. How'd you like to be the CEO of Blockbuster in the last 3 years? Because that's what one of your companies might be if they're not paying attention. And again, this isn't an intelligence problem. I want to just tell all your CEOs of large corporations, you don't need to understand the tech or the new business model. You do need to understand that the mindset needs to change of you and your people, and that they're not the same people. That you need to be able to, as I said, execute your core business at the same time, building an end-to-end process that allows continuous innovation with different risk profiles, different financial metrics, different whatever, different promotion stuff, different types of investment techniques that integrates all this stuff with the goal that says, if we believe the world is going to be different, how are we going to be part of that rather than just be kind of roadkill?
Right.
Right.
You want to be a part of the change, not victimized by it, right? And that is, I think that's exactly what corporate venture capital done right holds the potential to do.
And I think that the message that, for public companies, they need to remind the street, and which, they understand in other markets is, listen, we're going to be running a lot of experiments. We're not putting the core business at risk. Some of these subsidiaries or tests or whatever are going to fail, and a couple will blossom. And let me remind you what the success to failure rate looks like in a VC funnel. And we're in that same kind of activity. We're not betting the entire. The mistake that some large companies get into innovation make is, put all the chips on 32 black on the roulette table, right? Yeah, you can decide you want to bet the company, but that's an execution play, not an innovation play. So that's why you make lots of either small bets or buy things that are, further along, that have de-risked the things that are pricier, or get into consortiums or whatever. But there's a series, a portfolio of these activities that when you finally get signal out of noise, you could say, this looks like, it might actually have some product market fit here, and potentially partnered with us could get scale, and we could make change and, obscene profits if we kind of figure this one out. So.
Well, Steve, it's always so interesting hearing your thoughts. I've followed them throughout my career. I've hopefully put them to work as best I could in building Fifth Wall. And I think all the real estate CEOs that watch this and are thinking about how to improve and kind of future-proof their business and kind of address this confrontational change of really tech innovation, it's just exciting to hear your thoughts. And I'm excited to read your new book. And I just wanted to thank you for taking the time to chat.
Well, thanks for having me, Brendan. And I think both this video podcast and the work you're doing with corporates are going to accelerate change and help them survive into the next decade. So thanks for having me.
I hope so too. Well, thanks, Steve.